Thank you, Wendy. Thank you, Irene. Okay, thanks. Okay, let's start. So today we'll embark on a journey to actually explore CFD Spotlight, which is the gold, silver, and oil. Okay. Okay, so here are some disclaimer before we start. All of the content here are only for educational purposes. So please consult your TR or remisier if you wish to have some advice. Okay, so here are the contents for today. We'll walk through what exactly are CFD, why do we trade gold, silver, and oil, CFD, then the market drivers for it, and how do you open account for CFD. And then I'll show you the limited time promotion that we have. And then here are the key messages for today, which is the CFD has the flexibility for you that you need for your portfolio. And then as well as CFD has the ability to help you to achieve your financial goal. Because in trading or investment, most of our goals is to have higher profits every day, right? Okay, so now let's get started. Technically, first thing first, what are CFD? Okay, so let's break it down and understand the nature of CFD. So CFD is technically a derivative where the product's value is dependent on the underlying asset. So in this case, it's gold, silver, and oil. So a CFD gold contract actually tracks the underlying gold prices. Okay, so CFD is also a contractual agreement where a contract is actually between a buyer and a seller. So traders technically pays the difference in price when it opens and closes the contract. Okay, so CFD also is a over-the-counter product where it is not listed on any of the exchanges. So it's only traded via brokers, which is like us, Phillip Securities. Okay, so CFD, you do not own the underlying. So there's no ownership of the underlying. So you don't own the gold or the silver or the oil that you trade on our platform. So it only provide you the exposure of the underlying prices. Okay, so let's say for example, if you buy 100 gold USD CFD contracts, so it's actually just a contract between you and Philip. So you do not own the gold itself, which means that you cannot actually take the gold CFD contract and go to the store and then exchange for cash. So no, technically you don't own anything, okay? It's just a contract. Now, so here we have four different type of assets in CFD. So we have CFD equities or ETF, CFD indices, FX CFD, and commodity CFD. So for equities and ETF CFD, here we have around 5,000 plus counters in many different exchanges. As you can see here, Singapore, US, Hong Kong, Malaysia, and all. And then for indices, we have all the major indices, which is the S&P 500, and then we have China 850 as well, and then Hong Kong and Singapore and Japan. So for FX here, we have 39 FX pairs. So we have major FX pairs, minor, and some exotic pairs. So you're welcome to explore our platform. So most important here is the commodity CFD that we're focusing on today. We have 7 commodities CFD counters. So it ranges from precious metal, gold, and to oil. So let's zoom into commodities CFD here. Okay, now you can get access to the top 3 most traded commodities in the world, which is gold, silver, and oil. So here we have the different contract sizes, and CFD technically do not have any expiry. It will actually auto roll over for the next month, and the margin can be as low as 20%. So we also offer standard and micro lot contracts for all these commodities. Not all, but silver we do not have it, but mainly for gold and UK and US oil. Okay, so some will ask, why do we have all these different contract sizes? Let's say gold, we have gold USD1 and gold $100 USD. So what is the difference technically? So I'll explain this more in the next section. Yep. So let's dive into its mechanics of CFD commodities. Okay, so why gold, silver, and oil? So technically, gold, silver, and oil. Gold is actually an inflation hedge and a risk off asset. So technically, gold normally appears to be a safe haven asset during financial crisis, wars, or systematic shocks. So technically, investors during all these crises, they will actually flock to buy it. So technically, it would actually be a safe haven asset for them as in preserving value. So let's say, for example, for inflation hedge, right? When currencies weaken due to rising inflation or losing monetary policy, so gold is actually often used by investors to preserve their purchasing power. Okay, whereas for silver is actually a hybrid where it tracks gold and industry cycles. So technically it has a dual personality, like I would say, because silver sometimes will behave like gold during market uncertainty. So investors will either flock to gold or silver. So silver will be the second best option for them to go to during market uncertainty. But on the other hand, it actually trades more like an industry metal when market transition to manufacturing and solar energies and electronics. So when the economy is producing more, as in their manufacturing activities, so silver would most likely be the one that they go to as well, because there are a lot of things that we produce and we use in our products actually has silver in them. Okay, so the last one would be the oil that we're looking at here. So oil is actually a macroeconomic thermometer driven by geopolitics. So technically oil, as we see, it acts as an energy demand proxy. So we can actually know that it reflects the rhythm of global growth. So technically rising demand of oil often actually signals that economic expansion of a certain country. So failing demand of oil, like let's say falling demand of oil, I mean, can actually hint that there's an economic slowdown. So this oil is actually very highly sensitive to the conflicts in the Middle East and sanction. So while the OPEC plus production also can cause very massive price swing in oil. Okay, so now let's dive into its mechanics. Now, so the basic of buying and selling CFD actually works similarly to stock. So the golden rule is to buy at ask and sell at bid. Okay, so bid is technically the highest price at which a buyer is willing to pay, where ask is actually the lowest price at which a seller is willing to accept. So the spread here is the difference between the bid and ask, which is how we use to quote the bid and ask price on our platform. Okay. Now here. So this is the order ticket from our most popular platform, which is Poyon's platform. So how do you read this order ticket? So here for this particular counter that we have, which is the gold counter. So this gold counter is gold USD 1 CFD. So this CFD counter actually tracks the underlying gold price, as you can see here. So there's this bid price on the left and ask price on the right. So here, when you buy the 100 gold contract, may I know, do you buy at the bid or ask price? Can any one of you put in the chat? Just a quick one. So for this gold counter, right? So when you buy this gold contract, do you buy at the bid price or the ask price? Yeah, you can put. Okay, thank you, Irene. Ask anyone more? I mean, technically the answer is in the. Okay, wait. So Jason said that it was a bid. Okay, thank you, Charlene, and everything. Yep. I mean, the answer you can find in the slide lah. Yep. So technically, the most important thing is when you buy, you will buy at the ask price. So I saw someone put at a bid price. So why do not we buy at a lower price, right? Which is a 3326 as compared to a 3326.9, because 44 is lower than 90, ma'am. Because technically this is how it works, where in all of the trading platforms, there's this spread. So spread is between the bid and the ask, where normally you would actually buy at a higher price, which is the 90, and you sell at the lower, because in between the spread is what we earn as a broker, like as in a sense. So that's why you would normally buy at ask price and sell at the bid price. Okay. Now, so let's move forward. So here for this counter, you don't own the underlying gold. So you just get an exposure of the gold price movement. So now the difference comes in when you actually trade CFD as compared to equities or stock. So as you can see here, there is a margin required. So the margin requirement here for this counter is 20%. So technically it's the percentage of capital that require you to hold this position. So it means that you will need to have at least around $856 in your CFD account in order for you to hold this USD 100 gold USD 1 CFD contract. Okay, so you need at least $856 in your CFD account, Sing dollar, yeah, as you can see here, as GD. Okay. Now, thanks a lot for the response. Okay, now let's moving forward in here. So here I will need you to understand the difference in contract sizes. So here we have the gold USD 1 CFD contract and the gold USD 100 CFD contract. So it's 100 times of the USD1 contract. Okay, so for the gold USD1 CFD, it actually represents like every $1 movement in the price of gold, it actually equals to the USD1 gain or loss. So it's actually ideal for micro positioning and those who wants to fine tune the exposure. Okay, so whereas for this 100 USD, so every $1 price movement in the gold equals to how much USD gain or loss. Because I already explained the USD one, right? So can anyone put in the chat saying that if every $1 price movement in the price of gold equals to how much USD gain or loss for the big contract, which is on the right? Yeah. So can anyone put in the chat to guess how much USD gain or loss? Okay, thanks, Winston. Any more? Any more guesses? It's actually quite easy as well. USD one moon. Okay. So any guesses? Either USD 1 or 100 or any other guesses? Every $1 movement in the price of gold. For the big contract, yeah, gold USD 100 CFD. Thanks, Irene. Yep. Okay. So majority of them saying it's 100. So what I'm asking was just now is for the big contract, which is the gold USD 100 CFD. So yes, you guys are right. Every $1 movement in the price of gold equals to a USD 100 gain or loss. So technically the exposure and I mean this big contract amplifies your return and losses lah. So it's you need to be cautious whether you are trading the USD 1 or USD 100. So both have the same margin requirement at 20%, where the risk here, the difference is, which is the risk exposure. So the risk exposure for USD1 is technically lower and USD100 is higher because technically it's the 100 times, right, of it. Okay, so the lower exposure means you get smaller profits and loss, so suitable for those who are risk adverse. Okay, so for USD 100, you have much higher exposure, which is 100 times. But you have to be more careful because both the upside and downside are exactly magnified. So as for the flexibility wise, is we know that the smaller the contract, the more flexible it is. Because let's say, for example, if you want to hedge a perfectly 7 odds gold, how would you hedge? You can actually use this USD one contract, gold USD one contract, instead of the 100 one, right? Because you can position it as 7 CFD contracts for you to hedge your original gold that you have. Okay, so usually it is more suitable for normal retailers because it requires less capital as well for the small contract. Okay, whereas for the bigger contract, normally it's for institutional, I would say. Okay, or those who have enough money to actually buy the bigger contract. Okay, now, so how do we calculate the P&L for this gold USD one contract? So we will just use the small contract because normally retailers will actually use this. Okay, so here we'll use the micro lot size, which is USD one. So every index point is actually worth $1. Okay, so one movement in gold price will worth the USD. Okay, so here, let's say, for example, if we long gold USD 1 CFD, so price at time 0 will be 3,000, index point USD 1, quantity lot is 1 CFD contract. Okay, so margin requirement is at 20%, so we use the 3,000 to times the index point and you times the margin required. So technically, you would actually need around 769 Sing dollar for you to actually hold this. Okay, so let's say, for example, in time 1, the price rose to 3,005. So technically, you long means that you expect the price to rise, correct? So now the price at T1 is already risen to 3,005. So technically, you're making a profit. So how do you calculate a profit? Similar, 3,005, you minus 3,000, and you times the index point, and you times the margin requirement, you will get the profit that you have, which is USD 100. So it's around 128 Sing. Okay, so on the other side, short gold USD 1 CFD. So price at T0 is actually 3,003, and then the price has risen. So normally people who short gold would actually expect the price to fall. But then in this case, price at T1 actually rose more than 3,003. So technically you're making a loss. So here, how do you calculate your loss? Is similar. You use 3,003, you minus 3,005, and then you times your index point, and then times your margin requirement 20%, and then you'll get your loss, which is at 40 USD. So it's around Sing dollar and 51. Okay, so I have a question here saying that one contract of USD1, does it mean exposure of 1 ounce price movement? Yes, you are right. So it's considered a 1 ounce price movement because it's USD1 contract. Yes. So technically, 1 ounce is let's say for example in this case, let's say 1 ounce is 3,000. So when 3,000 it moves to 3,001, so technically that 3,001 is worth that $1. Yeah. So technically it's the same thing. One USD1 can be considered as a 1 ounce price movement. Yeah. Okay. So next. Okay, so let's deep dive into the market drivers for gold, silver, and oil. Okay, what are the main drivers here? Okay, can everyone see this? Okay, yep. So here, the first thing first, for macroeconomic movers for all these three different commodities, first thing first is the most important thing, which is the inflation. So when inflation rises, purchasing power of money fall, then investors would often turn to gold because gold hold its value well. Okay, so the higher the inflation, there's the higher demand for gold, so it will drive the prices up. So on a side note, let's say for example, inflation actually also actually pushed the cost of production up, as those who are refining oil. So oil companies would actually pass the rising cost to consumer directly in the form of like higher oil prices technically. So this also contributes to higher oil prices when inflation is coming. So when you see inflation indicators are actually higher in all those reports, and then you can actually opt for in buying, let's say long term, those people who day trade, then you can opt to buy gold or oil in this case. Okay. So essentially, let's say inflation is actually make gold more attractive as a store of value, while oil gets pricier because it's directly tied to rising costs of the economy. Okay, so next would be the Fed's decision. So technically, rate cuts would actually boost precious metal. Why? So when when the Fed decided to cut rates, which is lower interest rate, right? So this actually reduced the opportunity cost of holding gold because investors are not actually missing out much by holding metals that actually don't pay interest. So that's why, let's say for example, in I think 2020, okay, in 2020, when the Fed actually slashed the rates to near zero when during COVID-19, so gold actually rallied above 2,000 per odds for the first time. That's what I remember. Then it's actually because driven by safe haven demand. Well, a lot of investors actually demanded for it. Okay, so let's say for example for rate hikes, this is the inverse, which is the Fed increasing interest rate. So it would cause investors to actually rotate out of commodities into interest-bearing asset like bonds, and then which actually push down gold which push down gold prices. I mean, okay. So let's say for example, I think in 2022, I think Fed also aggressively hiked the rates a lot to combat the inflation. So I think I remember the WTI crude oil was actually being pulled back from I think around 120 per barrel, and then it fell to around 80. So even there's actually supply during that time, but it's actually because of fears of reduced demand for oil. So that's why the prices actually fell from 120 to around 80 per barrel at that point of time. Okay, so let's move on, which is employment data. So employment data is also a very powerful signal for commodity markets. So let's say job numbers are strong, and then it actually reflects a growing economy. So demand for oil and silver will rise most likely, okay, because expanding economy will actually need oil and silver, especially for transport, and then silver is to produce more products. Okay, so when employment data disappoints disappoints investors, so the inverse way, which is investor will grow cautious, and then their capital will actually often move to into safe haven asset like gold. So it works the other way. Okay, So let's look at this graph, which is the 10-year US Treasury yield versus gold prices. So I find this graph is very interesting. So as we can see that from December 2022 up to December 2023, the chart is actually showing an inverse stance, right, between the 10-year Treasury note yield and also versus the gold prices. So when Treasury yield rises, investors can have higher return on government bonds, technically of risk-free asset. So this actually make gold less attractive because gold don't pay interest or dividends, right? But the government bond does. So money often flow out from gold into treasuries, causing the gold prices to fall. So there's an inverse. So when yield increase, the gold prices fall. Because, however, in this graph, there's another snapshot where at the end we can see that starting from February 2024, right? Yeah, around there, both yield and gold prices are actually rising together. As you can see here, even though they're slightly inverse, but then you can see that both of them are actually increasing together. It's not as the huge difference, as in we can see that the inverse, which is in August 2023 to December 2023, where there's a huge inverse. But then from starting from February 2024, as you can see, both of them are actually rising together. So what has changed, right? Because if we take as a let's say we zoom out to a wider global view of this whole situation, because this one we are just looking at the 10-year trading unit of US versus gold price. So let's zoom out, not only just US. Okay, we take a wider global view of this whole situation. Actually, there are more foreign buyers who are increasingly turning to gold because gold actually stores the value well. So a lot of them, like let's say on a wider, let's say China or even Asia, as in Asia, actually see gold that can hold value well, and also turning it as a safe haven asset because of geopolitical tremors, got a lot of market uncertainty. So as a whole, in a global view of this situation is where a lot of foreign buyers are actually buying gold. So that's why even though treasury yield are increasing, the gold prices are increasing because of all this demand for gold. Yeah, so this is an interesting point to note. Okay, so in this section, we can dive into how silver and oil actually reflect the broader economic sentiment. So first thing first is the PMI, which is the Purchasing Manager Index trend. So this PMI actually serves as a forward-looking gauge of the industrial activity in US. So when the PMI rise, it signals stronger manufacturing momentum. So which actually will fuel both the demand for oil and silver. Okay, so as we know that when economic activity increases, so demand for silver and oil will automatically increase as well. Okay, so next point, which is the silver's dual role. So silver actually plays a very unique dual role in this world. It's just not an ordinary industrial metal that used in everything from electronics to solar panels, but it's actually also a monetary asset. So means it is actually benefits from the economic expansion as well. So it also at the same time act as a safe haven asset during economic uncertainty. Because during economic uncertainty, first thing what the investor would actually go flock to gold. But the next best alternative asset is silver. So that's why silver has a dual role in here. I would say that silver is much more safer in the sense. Okay, so the next thing would be oil sensitivity. So on the oil side, price movement are actually closely tied to how investors interpret the global growth prospect. So let's say, for example, a surprising uptick or drop in the PMI figures, right? This can actually quickly sway oil prices also because it actually reshape the expectation of the investors about how the future oil demand. Okay, so another major thing is to note how the oil is actually sensitive to the Middle East tension. As we know that recently the US and Iran issue. So let's say, for example, Iran actually do close the Straits of Hormuz. So the Strait of Hormuz, right, is actually the one of the most important shipping routes for oil and gas. So mainly, they ship a lot of barrels to Asia, like including Singapore and then China, a lot of the places. So most likely, expensive like if Iran technically closed that Straits of Hormuz. So keeping an eye on all these economic indicators, right, can really help you to anticipate inflection points in the commodity prices. Okay. Now, let's move on to why you should trade commodity CFD. So here, so technically similar to CFD. So because first thing first, commodity CFD especially, actually allows you to go both long and short. So technically, depending on your view or your play in terms of a certain commodity, you can actually place a both long and short view. So it is onto you whether how you want to use it. So depending on what strategy that you are using. Okay, so you use as little capital for commodity CFD, which is as low as 20%. So you only need to put up a certain portion of your capital in order to open and maintain a position with us. Okay, next thing will be there's no ownership, as how I mentioned before. So you can put your perspective into play without owning it, because let's say, for example, if Iran-Israel war spark a third world war, gold will be the first thing that investor will flee to, right? The next would be silver. So technically, how you want to put your play to it is I would technically long gold, gold and silver. So because mainly it's safe haven asset. I mean, towards the whole world is a safe haven asset. Okay, so next would be access to the leverage. So you can get from 5 times onwards of leverage. So this one is those other kind of our counters that start with 5%. So that one from 5%, which means that you can get 5 times plus leverage. So if you need, you can top up sufficient fund and email to us to negotiate the leverage and commission if you want to. Okay, so it also depends on the risk committee approval. So this one, the leverage we can also discuss if you need more leverage. Okay, next will be the competitive spread. So spreads technically are narrower for us, which you can actually refer to our website for different counters. So for us, for gold, it's still okay, I would say. So you can even open an account with us first to actually check it out if you like, and then before you can fund in and trade. Whereas for the platform here, we have our premium CFD MT5 platform for advanced traders to trade, and mobile apps for trade execution at your fingertips. Okay, so let's see the difference between CFD, physical, and futures. So first thing first is the thing that I want to go through, which is the cost. So CFD spread is normally narrow, but we have the cost of spread, commission, and finance charge. Whereas for physical commodities is almost too expensive for a normal person, because you need to pay for the premium and you have to find a place to store your physical commodities then you have to pay for the storage cost. Whereas for futures, we have also the spread, commissions, and other fees as well. So it's actually similar to futures, but it depends on which broker that you use. Okay, so next we'll look at the accessibility. So accessibility is where CFD, it is actually high because you can actually access to CFD through online platform, like which is Poems, which is our Poems mobile, or you can access through different brokers as well. Because let's say, for example, for physical commodities, right, you do not exactly get the accessibility, because to buy physical commodities, you will need to get access to dealers and actual brokers to get the actual commodity. Yeah. Whereas for futures, the access is also moderate, because you need to get access to the exchange, which is like CME or ICE via broker. So let's say you can open an account with IB or TD Ameritrade or Philip Nova as well, so to get access to it. So it's similar to CFD as well, but CFD is mainly only through online, and then it's quite fast to get access. Whereas for expiration, CFD in this case, there's no expiration, so you don't have to roll over the contract because it's auto rollover. Whereas for physical commodity, you don't have an expiration as well. For futures, the expiration is actually in fixed terms. So let's say, for example, when it reaches the expiry date, you would either need to settle it in cash or physical delivery. If you do not want both, you can roll over to a later expiry contract, but you have to remember to actually roll over, because if not, when it reaches the expiry date, then it would technically deliver the whole gold or oil. Okay, so for liquidity wise, it's actually very important to have liquidity in the market during trading, so that you can actually enter and exit easier without having the need to actually keep waiting. Because for physical and futures, sometimes you might need to wait for a counterparty. So for CFD wise, orders will be filled almost instantly during trading hours. So CFD will also have a tighter bid and ask spread, which reduces your transaction cost as compared to physical and futures. Okay? No. Okay. So oh, okay. You guys are looking at the, okay, right. Sorry. Okay, so at Phillips Securities, we offer equities, commodities, FX, and indices trading in the form of CFD contracts. It's also available on POEMS 2, Mobile 3, and POEMS CFD MT5. Okay, so for commission rate, you can actually refer to our website for more information. So in this case, we have which is POEMS 2 and POEMS CFD MT5. Commission rate for POEMS 2 is standard, but for POEMS CFD MT5 is lower. So technically, this MT5 platform is for those self-serve clients that they know what they're doing and they know how to use the CFD MT5 platform, which I encourage you all to actually explore because it's technically easier and also much more friendlier, as in those who wants to day trade. Yeah. So investment wise, you can keep to POEMS 2 would be sufficient. Okay, watch list, both of these also both of these platforms also has it, and to help you stay up to date to your favorite counters. So whereas for the credit limit for POEMS, you have a limit of around 200,000, which is up to 5 times leverage. But if you want to use more, you can actually opt for MT5 because MT5 you do not have any credit limit. Yeah. Okay, whereas for counters, we have more than 5,000 counters in POEMS, while MT5 now we have around, we actually have around 600 now. It's just I forgot to update, but we are looking to add more counters. So for those who wants to trade on MT5 and the counters that you're interested, then you can actually email us as well. Okay, so the commodities that I mentioned just now for gold, oil, and silver are actually on MT5 platform as well. So no worries, you can have access in both POEMS and CFD MT5 for all the commodities. Okay, so whereas for ledger, POEMS is a multi-ledger while MT5 is single. So what is the difference is how we maintain the ledger. So let's say, for example, for multi, we maintain your currency in different ledger. Let's say, for example, we have Sing dollar, USD, Malaysia ringgit, or Japan yen. Whereas for MT5, we do not have different ledger. You will only have Sing dollar. So let's say, for example, the margin is USD. We will hold your Sing dollar equivalent of the USD needed for you to maintain a position. So let's say, for example, just now the gold, right? Let's say we need around 600 USD to maintain, but we will hold an equivalent of that USD 600 in Sing dollar in your MT5 account to hold that position. Okay. So whereas for hedge mode, so this is very friendly for those who trade a lot, which is available only on MT5. Okay. So it means that you can open long and short contract position at the same time. So you can technically, it's called the hedge mode. So you long and short the position. Either you lock in some profits at a point of time, then this is how you use the hedge mode normally. Okay, now, so here I can guide you on how to open your POEMS CFD account. Here. So you need to have a POEMS account to get access to CFD. So either you can use My Info to speed up the account opening process. And here you will need to scan this QR code for more information, and you can actually directly pull you to this page that you can sign up. So new customer, you may create an account via poems.com.sg and follow the steps. So for you to open your MT5 account now, you can actually click to opt in to open your MT5 account directly from the sign up page. So once you scan this QR code, you go inside and then you can click open an account, and then here you can see follow step 1, step 2, step 3. So for those who want to open MT5 together, you can just tick the MT5 option as well. Okay, so alternatively, you can actually call your TR or walk into our Phillip Investor Center to open your account. So we have quite a few locations around Singapore, which is Belfast City, Ang Mo Kio, Bukit Batok, Bukit Timah. I think Jurong East or Jurong West also have. And then Marine Parade, Marsiling, and then North Point. Okay. Next. Okay, so for our existing client who already has a POEMS stock account, so you log into your POEMS and then you go your account management, you go CFD, and then you go online account opening and choose opt in into CFD. So actually I saw here, if I have Cash Plus account, can I trade CFD? Okay, So you can actually trade CFD. So you have to follow this, which is a CFD opt-in procedure for existing clients. So you can log into your Poems account, and then you go to account management, go to CFD, and then go to online account opening to choose opt-in into CFD. So provided you also have to complete your CKA and risk fact sheet lah. This one is for the SOP that you have to follow. Okay, so here is how do you actually fund your Poem CFD account. Okay, so here you can watch the tutorial on how to direct credit your funds into our CFD account by clicking the link here. So let's say, for example, I can send this link inside. Okay, sorry, maybe my colleague Vanessa would send you the payment link to actually see how you can go to this page and watch the tutorial on how do you fund your account. Okay, please note that you have to input your 7-digit account number followed by CFD when you fund in, yeah? Okay, so there are quite a lot of questions, so later I'll answer it one by one. So let me go through this first. If you want to top up your CFD account through your stocks account, you can log into your Poems account and you go account management, and then you go CFD, and then you go online forms. Then after that, you go to the withdrawal form. So you key in amount and you select transfer into CFD account. Then you write, which is for CFD trading. So technically, these 8 steps. Okay. Yes, thank you very much, Vanessa, for sending that. Okay, so let's go. Next one is the limited time promo, which is technically 3 days. So we have upcoming promotion, but it's not exactly confirmed yet. So this is a limited time welcome promo that we're having now. So you can scan this QR code for more information, and then you can earn up to 500. But because now you have only left 3 days, so I do not think that it's actually 500 that much. But the easiest is to earn is actually your first CFD trade that you can earn up to 100. So do know that this actually do not exclude the minimum commission that you have to pay. So take note on that. Okay. So these only have left 3 days because it's until 30th June. So here's more information. You can actually scan the QR code. So when you make your first CFD trade, you can earn $100. So every subsequent CFD trade after that, you can actually get $10 up to a total of 400. So total that you can earn is 500. So technically you have 3 days now. So I would think it's only around 100, 250 that you can earn. Yeah, better than nothing. So yes, if you're more interested, then you can actually scan the QR code. So let me see the questions. Okay, so let's say, can I send USD directly to my Poems account and trade CFD in USD? Or does it have to be in sync? Okay, yes, good question. So you can actually top up USD. So technically you would need to email to us that you are topping up in USD. Oh, so you see you are topping up in USD. So as of now, right, we do not have this option yet. You need to top up in sync and then you convert in USD. Then you can trade using USD, because if you top up in sync and convert into USD, you do not actually need to pay something called a margin deficit, because technically if you do not have the certain currency in your account that you are trading in, let's say I trade US, right, and my account do not have USD, I only have sync, then you will be charged a margin deficit, because if we will take it as we lend you money to actually trade, which is lend you in USD to trade, even though you have money in sync. So I would suggest you, for those who want to hold longer term, as in, like, let's say if I buy and you hold like 1 month, 2 months, 3 months, it's better for you to actually convert your money into USD and trade in USD. So for those who are day trader in and out, you can don't need to convert to from Sing to USD, because technically you will need to eat the exchange rate if you were to do that, because if you were to always convert. So it's easier for you to everything maintain in Singapore dollar. Yeah, for those who are day trading. So is it I need to pass SIP to trade CFD? Yes, you will need to pass, which is the CKA in order for you to trade CFD. Yes. CKA, CAR, you have to go and fill up that, and also to see, depending on your background as well. If you are studying finance or anything, if you have past experience of trading it, then you do not have to you do not have to, you just have to declare, but you still have to go and fill it in and pass it up. Yeah, so if you do not have it, then you need to go to a certain website in order for you to pass the CKA in order for you to trade CFD. So, okay, moving on. Yeah, so there's only 3 trading days left. So you can actually stand a chance to get $250 technically. So which is tonight, tomorrow, and Monday. So I will transfer from my bank in US to Poem's account in USD. So for this one, right, I would say either you can deposit it in check, but I would say if directly into the account, I would say no. So you will need to you can, but then you need to email us so that we inform our operations that you are doing this way. Because normally on our payment website we only put the pay now, which is Sing dollar into the account. So if you need that, yes, you can email it and then we will help you to process accordingly. Yeah. Okay, so are there any other questions? Yeah. So technically, are there other questions for this? Okay, if there's no other questions, thank you everyone. And if you need anything, you can actually email or call us to our dealing desk so that we can serve you better or anything you want to request. Yeah. So you can take a screenshot of this so that you can send us an email or give us a call. Okay. There are no other questions, right? Okay, thank you very much, everyone, and I'll see you next time. Thank you.